So now I think you want the strategy, right? Because you have learned a lot of things so far and you want to keep to use them in your trading. So this lesson is going to be the first lesson that I'm going to give you an actual strategy of how to combine all the things that we have learned so far to create a profitable strategy. So how to create a profitable price action strategy. So to create a profitable price action strategy, I found out that there is a simple way, or there's four main things that you want to look for before you place the trade. So first of all, you want to identify the trend or the direction, or what the conditions of what the market structure is at that point. So the trend, as I said, as we learned in the past lesson, that the trend is very important to follow the trend if you are trading, if you want to get high probability trades, because if you try to go against the trend, most of the time you are going to generate a lot of fake signals and you are going to be stopped out in the market a lot of the times. So the trend is the first thing that you need to look for, and for you to identify the trend, you want to be able to identify the 1 2 3 move that we said. We are going to talk about that. Number two, you want to identify the area of value or your support and resistance zone, whether it's dynamic support and resistance zone, whether it's dynamic, horizontal, diagonal, or any another support and resistance, or maybe counter trend, which is what we are going to talk about that in this strategy. Then the number three, you want to know the end triggers, what triggers you into this market, and why are you wanting to see the direction, the area of value, the end triggers. What I found out is that most of the time, for you to create a high probability trades, I like to create a trade with three confluences. The number one, the trend; number two, the area of value; number three, the entry trigger. And also we have the exit scenarios, because remember in the first module we were talking about your success as a trader doesn't come with placing trades. It comes with you exiting the trades, or knowing exactly how to manage your running trades, because it's easier to enter a trade, but it's it's 3 times harder to exit the trade that you entered than to enter in a trade, because exiting the trade is what determines if you are exiting with profits or if you are exiting with loss. So it's very important. We have what is called the TAEE, trend, area of value, entry trigger, and exit scenarios, right? So the first step is to look at the trend. What is the trend of the market, right? So for you to identify the trend of the market, you want to identify what we call the 1 2 3 move. And what is the 1 2 3 move? Remember what I said in our previous lesson. We said that if you are looking at a trend, you want to see the impulsive move, the pullback, and another impulsive move, because the impulsive move, the pullback, and another impulsive move shows you that this market is in this kind of a trend, right? So for example, let's say you were in an uptrend and you want to look for buy trades. How do you identify the uptrend, right? You want to see a move that is like this, a pullback, another impulsive move, and you want to make sure that this is your 1, this is your 2, and this is your 3. You want to make sure that these 3 here, some call it the ABC move, but if this 3 here breaks past this zone, you are now having a clear trend, because you have the 1 2 3 move, impulsive move, pullback, another impulsive move. So now chances is the market can continue going to the upside, right? So go into the market, find wherever you see the 1 2 3 move, and you are going to likely create a high probability trades, or the market is likely to be in an uptrend or in a downtrend. So if you are in a downtrend, on the other hand, you want to see the market pushing down and another a pullback, and then pushes down, and then this breaks past this zone, and then we have the 1 2 3 move, right? So with the 1 2 3 move, you are going to be able to identify the short term or the trend that have already been established, because now we have an objective way or an objective rule based move that we can identify and say this is definitely an uptrend, right? So once you see this, I'm going to show you an example right here. So what is the 1 2 3 move in this market, right? So if you were following through, we said we just want to see the market going up, and then we want to see the market going down with like 2 or 3 candles. So we have this move right here, from here to here. It's called an impulsive move, and this is our 1. And then from here to here we have our 2. We mark out this zone and we mark out this zone, and we wait for the market to break past this zone, and now we have our 2 and we have our 3. That's our 1, 2, 3 move right here, right? Now, once we have this 1, 2, 3 move, the next thing that we want to we are now interested in this market, but we are not going to be placing the buy trades right away. What are we going to do here next is we are going to wait for the next part of this move, which is what is called what? The area of value, right? So what is the area of value that we are going to use? So in this strategy specifically, we are only looking for medium pullback, right? And what is a medium pullback? A medium pullback is a pullback that comes back into a previous higher high. So on our 1, 2, 3 move, it looks like this, right? So we're marking this zone. So we want a pullback that comes into this zone right here before we think about buying, right? So we want to look for area of value and mark this zone, right? Now remember, we are not yet buying. We don't want to see the 1, 2, 3 move, and we want to wait for a pullback that comes back into this zone, right? So that means if you see a market which already looks like this, you can just already mark out this zone. You see, okay, this market is now on our previous zone. Now I'm waiting for the market to come back into this zone. And how does that happen in the market? It happens because I'm going to show you an example, because the market creates a pullback. These pullbacks are likely to be medium pullbacks, deep pullbacks, or shallow pullbacks, but in this case we are only looking for shallow pullbacks, so for medium pullbacks, sorry. And then we are going to mark out this zone right here. And some of you ask, how do I mark out this zone? The way that you mark out this zone is that you take the rectangle tool on your MetaTrader, and then you can mark out also with horizontal tools, but you just want to make sure that this is not a line. This is a zone. What is support and resistance? Support and resistance is a zone where the market have reacted to and is likely to react to again. So it's not a line, it's a zone, because the market is moved by masses, and all these people are not going to place orders at one point, right? So now we see that the market is coming back. We have now come back into the area of value. So we have the 1, 2, 3 move, we have the area of value, and now the market is in the area of value. We want to now look for trades, but before we look for trades, we want to also look for the step 3, which is entry triggers. And the entry triggers that we use for this strategy are very easy. Remember, rejection candlesticks. What is a rejection candlestick? A rejection candlestick is simply a candlestick that have got a long wick to the upside or to the downside, or either that have got indecision, right? So if the market is moving like this, makes a pullback, moves up again, now we mark out this zone. The market come back to that zone, and on near that zone, or on that zone, we see a candle maybe which looks like this. What does this candle show you? It shows you that the market tried to go down and then it reversed, and this candle is called the hammer. Or we can see a candle which have got no wick and we have got no body and very big wicks to both the upside. So it means there is now starting to have competition at that zone. And if you are in an uptrend, your bet as a trader is to say that the market is likely to go in the direction of the market, right? So once you see this happening in the market, that's when you start to thinking about buying, right? So now we have our 1, 2, 3 move, right, which is our condition or our trend. Then we have our area of value, which is this zone right here. And now we have our entry trigger, which is our candlestick pattern, right? And if you look in the real market, we are going to see that these candles are created mostly on these zones. That's why we came up with this as a strategy, right? So we have our entry trigger, we now have our zones here, you can see. And also if you look closely right here, you are going to identify this candlestick pattern, which is right here. So we have the first one right here, which have got a long wick to the downside. You also have an indecision one here. So you'd either place your trade right here, or you would either place your trade right here. But before you place the trade, there's one more thing that you need to identify, or that you need to understand, which is what is called the exit scenarios, right? So for exits, you are going to do two things. Number one, you can exit based on risk to reward ratio. Number two, you can exit based on area of values. For me personally, I like to use area of values, and I want to for the exit, what I do is the stop loss is what determines the exit, the exit, the take profit, right? So for example, let's say I buy a market and I put a stop loss of 20 pips. I would say I need a take profit of 40 pips or 30 pips, which is more than the stop loss, so that I can create an advantage with what is called the risk to reward. We are going to talk about those in the risk management section of this course, right? But first of all, your exits is gonna be determined by your by either the area of value. So now for the area of value, what I mean is simply this, right? So remember I said if this market moves up here and goes all the way up again to this point and now pulls back, if this market goes below this zone, which is our higher low, if this market goes to below this zone, the trend is not going upside again, so it is likely you have reversed from this point, right? So in this case, you can see I will put my stop loss at a point where I see that if this market moves all the way down here, that simply means we are no longer in an uptrend. So why would I want to be in a buy position? Let me exit this market and say, okay, I am wrong. So in this case, I would put my buy trade right here. So this is the buy trade. Remember, this is the buy, this is the stop loss, and this is the take profit. And why did I put my take profit here? I just did 1.4 times the risk. So if this is 30, so if let's say this was 30 pips, that simply means this is going to be like 40 pips to 50 pips, which is above the 30 pips that I have right here. So the take profit is determined and is always going to be bigger than the stop loss most of the time, and almost every time. I just want to do that, make sure that my take profit is bigger, and this helps me to say if I place 10 trades and if I lose 5 and win 5, that simply means my winners are bigger than the losers, and then in that way I'm not in loss. I might not make a lot of money, but either way I am not in loss with that trade. So in this case, you can say that this is just an example, but the market went on to go all the way up and hit the take profit, right? It's not going to happen every time of the market, but as I tested, this is a very good strategy. So to make sure that you really understand this, let me give you another example, and in this case I want you to be able to identify the 1, 2, 3 move. Hopefully you were able to clearly see that the 1, 2, 3 move that we have here is going to the downside, right? So we have the market moving from this point, making the 1, making the pullback, and making the 3, right? Now once we are here down here, we are just waiting up, and we are already marking out this zone, right? Once we mark out this zone, we want to be able to identify when the market is gonna come to that zone, right? So firstly, find the 1, 2, 3 move, and this is the 1, 2, 3 move that we have in this market. Then step number 2, we want to be able to identify the area of value. And what is the area of value in this case? You are going to see that since we said this is the 1, 2, 3 move, our area of value is this zone right here. So I mark these zones with big rectangles. Why? Because I like to just use the size of the candles at that zone, because the size of the candles at that zone is what determines how volatile was the market at that zone, how strong was the momentum of buyers and sellers at that zone. So that's why I use the size of the zones as the rectangle of my as the size of my rectangle. And now what I'm just waiting for is for the next time when the market comes back into this zone right there. So in this case, the market comes back into this zone. But before I buy, I need to go into step 3. What is step 3? Is finding your entry triggers, right? So what is your entry triggers in this case? Your entry triggers should be rejection candles. So here you can see in this zone, what do you start seeing here? Rejection candles with big wicks to the upside and also to the downside, showing you indecision. And what does indecision means? Indecision means anyone from this point can be able to win this market. So here you can see two candles with a lot of rejection. This one was rejected all the way up and down. Also this one was rejected to the downside, right, showing you that sellers tried to push prices lower but then failed. And then in the next candle there was indecision. Buyers and sellers are struggling to push prices at this point. So from this point anyone can win this market. So now I have my 1 2 3 move. I know we are in a downtrend. Now we have pulled back into my support 1. Since we have support 1 here and we have another support 2 which I didn't draw here, because in this strategy we are just focusing on this zone when the market is maybe going to create a medium pullback. So we are trying to capture medium pullbacks in this case right here, right? So once you see this, the next thing is you want to look for when are you going to exit, where is my stop loss and where is my take profit. So if you enter here, you are going to put your stop loss above here, knowing that if the market goes all the way up here, it is likely now to change direction, right? So now notice that I didn't put my stop loss above this zone here, but this is because this zone is just far away from my entry, so I cannot put my stop loss very big. The stop loss needs to be wide enough to accommodate any volatility, but also you don't want to place it where it will affect your risk to reward ratio, right? So I put it right here, but here is a reasonable point to say if the market goes all the way up here, it's either going to be a deep pullback, but if it is a deep pullback I will get another trade. But here the point that I'm making is the reason why I didn't put this stop loss above this zone is because this zone is just far away. This impulsive move was too big, so I don't think the market is going to be able to pull back and cover all this impulsive move that is here, right? Because once I see that, I'm placing the trade here and the take profit is 1.5 times the risk, and then the next thing that you see is the market going to the downside. This is an example. Remember, all these are cherry picked, but I'm showing you this because I know that in the market the chances of this happening, the reason why we are seeing this over and over again, even though I'm picking here, is because this happens every time. I place the trades with these strategies almost every day in the market, because this is one of the most reliable strategies, and I'm sharing with you today so that you can be able to see profits in the market, right? So now let's look at this market and let's show me where do you see the 1 2 3 move and where do you see where we are likely to place the trade. Just feel free to pause the video for a few seconds and try to identify before I explain to you what is going on right here. Okay, so now we can see that the market was moving to the upside all this time. So this market was moving very much to the upside. So the market was moving very much to the upside, creates a big move to the upside, pull back, move to the upside, pull back, move, pull back, move, pull back. But now here you can see at this point right here. So if we were marking out these zones objectively, we have a higher high, we have another higher low, higher low, a higher low. Here, this is our last higher low. Why? Because the market goes all the way up. If the market doesn't go to break up here, this is not a higher low. So here what happens is this, and it breaks past this previous higher low. Once it breaks past this previous higher low, you know that this is no longer an uptrend. It is now likely a downtrend. So we are looking for the 1 2 3 moves that goes to the downside. So we have this move right here, pull back, this move right here, and now this is where the market is at as I'm recording this, as I'm showing you this. So this is not an example, it's like a live trade that I'm going to place very soon if it plays out like the what I was showing you. So now we are marking out this zone and we want the market to come back into this zone. When the market comes back into this zone, we want to see a rejection candle here, something with a long wick to the upside, or something of indecision, some kind of a doji, some kind of bullish engulf, bearish engulfing candles, any shooting stars, evening stars, whatever that shows you that there's something happening here. I would like to see those before I place the trade. And how am I going to place the trade? So if the market comes back to this zone, I will put my sell trade right here, right? So I will put my sell trade here. My stop loss is going to be above this zone, and then from there I will put my take profit right below here. So most likely I'm gonna put my stop loss here, and we are going to put our take profit down here, because I'm thinking that this is a downtrend that is starting out right here. And if it is a downtrend, if you catch it as early as possible, your chances of making money are very, very high. Now, this is the strategy that I want you to start using today. Go ahead and practice this strategy. You can watch this video again, or go ahead into your market, start looking from the left of your charts, move your charts slowly, and then try to identify whenever this happens, and try to see if you are going to see your trend, your entry triggers, your area of value, and what happened to your exit scenarios. I did the back test for this, and this strategy wins more than 60% of the time, and it's likely to give you a good profit if you are trading, and if you are using 1 to 1.5 risk to reward ratio to 1:2 risk to reward ratio. It's called the counter trend break and retest strategy. So thank you for watching this one, and then what happens is in the next lesson we are going to talk about another any subject or indicators. So what is going to happen here is that in the next lesson we are going to talk another subjects that we use in technical analysis. Then after that subject we also show you another strategy that you can use on that. So in that way you are going to be able to see that each and everything that you have learned, you can put it in is to a strategy. So in this case you can see that you in the first day you learned about market in the first module you learned about how the market moves and how psychologically it affects you in the market. And then in the next one you learned about candlestick patterns, and then after candlestick patterns you learned about trends, support and resistance, and now we can we combine all these things to create this strategy. So that's how we create high probability strategies in the world. So now let's go ahead into the next lesson, and let's talk about how we are going to use another tools like Fibonacci and another things that we have found in price action. Then in the next module we will jump ahead to start talking about indicators and how to use indicators. Thank you for watching, and let's go ahead into the next lesson.